Today, the risks are building, they say. Hello again, it's Martin North from Digital Finance Analytics, one that is posts covering finance and prop news with a distinctively Australian flavour. Well, if you thought that 2022 was bad, with surging inflation, the war in Ukraine, and China's slowdown all impacting, I'm afraid to say that economists seem to be lining up to suggest that 2023 could be even worse. On Tuesday, the IMF cut its forecast for worldwide growth in 2023 and said that policies to tame high inflation may add risks in the global economy. And in their press conference, the mood was, well, downbeat and concerned.
Global financial stability risks have increased with a balance of risk that is skewed to the downside. Amid highest inflation in decades and extraordinary uncertainty, markets have been extremely volatile. Risk assets such as equities and corporate bonds have declined sharply. A deterioration in market liquidity has amplified price moves, and financial conditions have tightened globally. In many advanced economies, financial conditions are now tight by historical standards. In some emerging markets, they have reached levels last seen during the height of the COVID-19 crisis. With conditions worsening in recent weeks, key gauges of systemic risk, such as higher dollar funding costs and counterparty spreads, have risen. There's a risk of disorderly tightening in financial conditions that may interact with pre-existing vulnerabilities. Investors may further reassess the outlook if inflationary pressures do not abate as quickly as currently anticipated, or if the economic slowdown intensifies. While in emerging markets, rising rates, worsening fundamentals, and large outflows of capital have pushed up borrowing costs notably, the impact has been especially severe for more vulnerable economies where 20 countries are either in default or trading at distressed levels. Unless market conditions improve, there's a risk of further sovereign defaults in frontier markets. Our global stress tests for banks show that under a severe downturn scenario, 29% of emerging market banks could breach minimum capital requirements. And of course, corporate credit is also facing an increased risk of default. We have also seen turbulence in markets in some specific countries. Central banks must act resolutely to bring inflation back to target, to keep inflationary pressures from becoming entrenched, and to avoid the anchoring of inflation expectations. The high uncertainty clouding the economic outlook hampers policymakers' ability to provide explicit and precise guidance about the future path of monetary policy. Clear communication about the policy function, the unwavering commitment to achieve the mandate of price stability, and the need to further normalize and in some cases tighten monetary policy is crucial to avoid unwarranted market disruption.
And the Bank of Spain Governor Pablo Hernandez said that some of the shocks in the European Central Bank's downside scenario may have materialized. The ECB had published two different scenarios at its last meeting in October, a baseline and a downside version that foresaw stronger inflation and a contraction in economic output in 2023, although Decaux did note that energy prices were a little lower than in their central scenario. The uncertainty justifies the ECB's decision to abandon forward guidance and take a meeting-by-meeting, data-dependent approach, he said, speaking at the Institute of International Finance conference in Washington. And asked about the implications of the latest market rout in the UK, Decaux said if it's properly managed, it shouldn't be contagious. European Central Bank President Christine Lagarde said that policymakers are determined to bring down inflation and argued that cooperation with other monetary authorities and fiscal policy is necessary to succeed. We have to have cooperation among ourselves, central bankers, to understand what the spillovers will be, what the spillbacks could be, what impact we have on each other, and what ramifications it will take, because financial markets are extremely integrated and because our respective monetary policies have an impact on other countries around the world, Lagarde said at an event hosted by the Institute of International Finance. We also have to have cooperation between monetary and fiscal policies, he said. We have to act in a cooperative way because if we don't, then monetary policy is going to have to be even more determined and more decisive in its fight against inflation. And Treasury Secretary Janet Yellen cited concerns about the potential for a breakdown in trading of US Treasuries as her department leads an effort to shore up that crucial market. We are worried about a loss of adequate liquidity in the market, Yellen said on Wednesday, in answering questions following a speech in Washington. The balance sheet capacity of broker-dealers to engage in Treasury market making hasn't expanded much, while the overall supply of Treasuries has climbed, she noted. And even President Joe Biden said this week that the US, the world's biggest economy of course, could suffer a, quote, very slight recession. And the producer price index for final demand climbed 0.4% from August. That's the first increase in 3 months and was up 8.5% from a year ago, according to Labour Department data released on Wednesday. Excluding the volatile food and energy components, the so-called core PPI increased 0.3% in September and advanced 7.2% from a year earlier. Now, the median estimates call for a 0.2% monthly increase in the PPI and a 0.3% rise in the core. And while supply chain disruptions have generally improved, costs rose for energy, food and services, and 2/3 of the increase in the PPI was traced to services as prices rose for travel and accommodation, food retailing, portfolio management and hospital inpatient care. And so the point here is that inflation read was a lot higher than expected, which of course underscores once again that inflation is not under control. And the Fed minutes of the Federal Reserve September 2021 meeting, which was released on Wednesday, underscored that policymakers reaffirmed their strong commitment to returning inflation to the Fed's 2% goal, with many officials stressing the need to stay the course, even as the labour market slows. And the consensus was to purposefully move to restrictive stances in the near term, though several officials saw it as important to calibrate the pace of tightening to minimise harm to the economy. And a few market participants grabbed on that straw as saying, see, we're not going to go at it quite as hard. But many officials saw the need to maintain restrictive rates for some time, with several saying that such a stance could be held for as long as necessary. And the minutes offered no new details on the size of likely rate moves in the November FOMC meeting, or indeed future gatherings. But policymakers did back the continuance of the balance sheet shrinking at the current pace, with a couple of officials saying it would be appropriate to consider mortgage-backed security sales after reductions was well underway. So with no notable pushback in the FOMC minutes against the current pace of rate hikes, we see the FOMC on track for another 75 basis point hike in November, Morgan Stanley wrote in the note. The bar for a Federal Reserve pivot away from monetary policy tightening is very high amid ongoing strength in underlying inflation, according to the Minneapolis Fed President Neil Kashari. If the economy entered a steep downturn, we could always stop what we're doing. We could always, if we needed to, reverse what we're doing if we thought that inflation was headed back down very, very quickly, he said on Wednesday during a town hall event. For me, the bar for such a change is very high because we have not yet seen much evidence that the underlying inflation, the services inflation, the wage inflation, the labour market is yet softening, he said. Oh, and by the way, the Federal Reserve posted its first operating loss in years as interest rates soared and demand for US bonds cratered. Of course, the Fed isn't a normal investor. It cannot go bankrupt, and any operational losses stemming from its various portfolio movements, particularly those of bonds, will simply mean it remits less money to the US Treasury. But it does highlight the dramatic shift in the economic environment and could make for uncomfortable optics at a time when the Fed is already under pressure to bring down inflation. The central bank has ramped up its fight against higher prices, paying added interest on bank reserves and through purchases like the Reverse Repurchase Agreement facility, better known as the RRP, as it attempts to dampen demand. The Fed's interest expense and interest it pays banks and the RRP counterparties increased with each rate hike, said Joseph Wang, a former trader at the central bank's open market desk and the founder of Fed Guide blog. The 75 basis point September rate hike pushed the Fed into an operating loss. With expectations for a higher for longer Fed, the operating loss is likely to be significantly larger in the coming months. As Wang explains, the move to an operating loss is notable because it so rarely happens. In the years since the global financial crisis, the US central bank earned more than $1 trillion in interest income that it remitted to the US Treasury. And the collateral damage here is quite considerable when you look at, for example, US mortgage rates, which advanced to a fresh 16-year high at 6.81%, extending a rapid ascent in borrowing costs that's seen dealing a bigger blow to the housing market. The contract rate on the 30-year fixed mortgage rose 6 basis points in the first week of October, marking an 8th straight increase, according to data from the Mortgage Bankers Association that came on us on Wednesday. That pushed down a gauge of applications to purchase or refinance a home by 2%, and that's the 8th drop in 9 weeks, to the lowest level since 1997. So all of this was the backcloth to the markets, and US stocks ended a very choppy session, slightly lower on Wednesday, after those minutes from the Federal Reserve meeting showed that policymakers really agreed that they need to maintain a more restrictive policy stance. And of course, the September meetings also showed that many Fed officials stressed the cost of not doing enough to bring down inflation. Recent market weakness has been tied in part to increasing fears among investors that aggressive rate hikes by the Fed could tip the world's largest economy into recession. Rate-sensitive utilities were down 3.4%, while real estate fell 1.4%. They led percentage declines among the S&P sectors for the day. Fed officials in recent speeches have come out in unison regarding the Fed's commitment towards curtailing inflation and staying the course, said Quincy Crosby, Chief Global Strategist at LPL Financial. There's an understanding now the Fed is going to keep going. The question for the market is where is the transition from 75 basis points to 50 and 25? That is what the market is focused on, I think. So the Dow Jones Industrial Average fell 0.1%, 29,210. The S&P 500 lost 0.33% to 3,577, and the Nasdaq Composite dropped 0.09% to 10,417. Thursday's report upcoming on US consumer prices will be considered even more key now and will be anxiously awaited by investors, along with the start of third quarter US earnings, which kicks off with results from some of the big US banks on Friday. Among the gainers, PepsiCo rose 4.2% though, after the soft drink maker raised its annual revenue and profit forecasts on firm demand for its sodas and snacks, despite multiple price increases. The snack and beverage giant's ability to pass on higher costs to consumers has caught the eye of investors looking to weather the current market volatility amid economic uncertainty and rising interest rates. If you want to weather this volatility until we answer the question of a shallow recession or not, Pepsi is the type of business that we will be looking at because it does have positive cash flow, good earning structures going forward, and they've invested in their own future growth, Brian Mulberry, client portfolio manager at Zacks, said. And elsewhere, Alcoa Corp jumped 5.3%. The Biden administration is weighing restricting imports of Russian aluminium as it charts possible responses to Moscow's military escalation in Ukraine. Energy, however, helped to keep the broader market above the flat line, despite a slip in oil prices as Valero Energy Corporation and Qatar Energy and Phillips 66 all racked up gains. Technology remained under pressure as gains in Alphabet and Microsoft were offset by a drag from weaknesses in chip stocks. In other news, Moderna jumped 8% after announcing that it would team up with Merck and Company to develop and sell a cancer drug. And over in Europe, European shares tumbled on Wednesday as nerves about soaring prices and rising interest rates were aggravated by that inflation data from the US, while mixed earnings reports kept investors on the edge with regard to corporate profits. The Pan-European Stock 600 index closed down 0.5%. That's falling for a sixth straight session. The Stock 600 is down 1.5% so far this week, with markets worried about aggressive policy moves from central banks to tackle high inflation and recent warnings from the International Monetary Fund and the World Bank exacerbating concerns about a recession. Financials, energy and industrials were the biggest drags on the index on Wednesday, which is on course for its worst annual performance since 2008. Meanwhile, British bond yields rose sharply after the Bank of England confirmed its programme of temporary gilt purchases would end on Friday. London's blue-chip FTSE was down 0.9%. And indeed, there was confusion reigning in the UK's markets as conflicting reports about the Bank of England's intentions undermined the message that Governor Andrew Bailey had tried to convey on Tuesday in New York. Bailey had said that the bank would stop buying UK government bonds outright at the end of Friday, switching to a regime of liquidity support based on repo operations, whose impact on the money supply can be neutralised more easily. However, unnamed financiers told the Financial Times that the bank has signalled it might be willing to extend its purchases beyond Friday nonetheless. And there was comparable confusion about the government's tax and spending plans, which are behind the volatility of UK markets. The government confirmed it would, after all, impose a windfall tax on renewable companies to finance some £60 billion of energy subsidies over the next winter. That encouraged hopes that more of the unfunded tax increase and subsidies that the new government had promised last month would also be unwound. Barratt Developments, Britain's largest home builder, warned of a fall in annual profits on Wednesday, sparking a sell-off in the sector. And overall, European companies are expecting to report a 29.4% increase in third quarter profits, slightly below the 33.2% rise forecast at the start of October. There's a school of thought in the market now that earnings estimates might be too high, that we really haven't fully discounted the effect of a potential recession. Philips shares fell 12.3% to their lowest in a decade as the Dutch health tech company said supply chain problems would hit sales and wrote down 1.3 billion euros of the value of its sleep apnea business. Credit Suisse dropped 4.2% after Bloomberg reported the US Justice Department is investigating whether the Swiss lender continued helping US clients hide assets from authorities 8 years after it paid a $2.6 billion tax evasion settlement. Among gamers, LVMH rose 1.9% after the French luxury goods giant beat market forecasts for third quarter sales. And European central bank policymakers are closing in on the deal to change rules governing trillions of euros worth of loans to banks in a move that will shave tens of billions of euros off in potential banking profits. Eurozone banks sit on about 2.1 trillion euros of cash handed out by the ECB at ultra-low, sometimes even negative interest rates, in the hopes that doing so would help kickstart the economy. But after a string of unexpectedly quick and big rate hikes, banks can now simply park this cash back at the ECB, earning a risk-free profit, irking policymakers who see it as gaming the system. Policymakers reviewed 5 options at a seminar earlier this month to change the rules of those targeted longer-term refinancing operations, the TLTRO, all of which were deemed somewhat problematic because they raised a legal or political hurdle or went counter to other policy goals. The 5 options were then narrowed to 3, and staff are working to refine them. We're very close, and a decision is going to come soon, according to those on the sidelines of the IMF and World Bank annual meeting in Washington. The ultimate design is going to hurt banks, and that is very much our intention. The impact of the move would be worth around 30 to 40 billion euros a year, while a second source said the impact could be much higher if rates rise, as markets now expect. French central bank chief François Villeray-Duguay, who has long advocated changing the terms of the loans, earlier this week said the ECB should avoid unintended incentives to delay the repayment of these funds. The problem is that the ECB's 0.75% deposit rate will rise further, probably close to 2% by the end of this year, and possibly higher in 2023, leaving the central bank with a huge potential interest exposure. Out of the three remaining options, the simplest would be to unilaterally change the terms of the TLTROs, so cash parked back at the ECB would not be remunerated at the deposit rate. The benefit is that all banks are affected the same way, and the ECB would not be playing favourites. But this option is likely to raise a legal hurdle, with banks possibly filing lawsuits. Another option would be that cash from TLTROs would be treated on similar terms as minimum reserves kept by commercial banks at the ECB. Such reserves are now remunerated at 0.5%. That's below the ECB's deposit rate. A third option would be to create a sort of tiering that would allow banks to enjoy more favourable terms up to a certain threshold, after which a lower rate would apply. Policymakers argue that it's politically unacceptable that banks earn such a windfall while the economy is in a downturn and ordinary people are suffering. And they also said that this sort of accommodation is inconsistent with interest rate policy, which is being tightened. But there is also a wider political issue at play. Paying interest on these excess reserves deplete central banking profits, limiting their ability to pay cash into national budgets and depriving the state of vital income. That risks putting political pressure on central banks around the Eurozone. In extreme cases, central banks could even deplete their own capital, possibly forcing governments to recapitalise lenders. Finance leaders at the Group of 7 advanced economies said on Wednesday that they'll closely monitor recent volatility in markets and reaffirmed their commitment that excessive exchange rate moves were undesirable. Recognising that many currencies have moved significantly this year with increased volatility, we have reaffirmed our exchange rate commitments as elaborated in May 2017, the G7 finance ministers and central bank governors said in a statement released by the US Treasury Department. The G7 finance leaders met on Wednesday on the sidelines of the G20 and International Monetary Fund meetings in Washington. Under the commitment agreed back in May 2017, the G7 agreed that excess volatility and disorderly currency moves have negative impacts on their economies and financial stability. Japan has been pushing hard to include a warning on recent currency moves in the G7 statement as it struggles to address the yen's slide to 24-year lows against the dollar. And in the statement, the G7 also said the group's central banks are strongly committed to achieving price stability and closely monitoring the impact of price pressures on inflation expectations. The G7 will continue to appropriately calibrate the pace of monetary policy tightening in a data-dependent and clearly communicated manner, ensuring that inflation expectations remain well anchored while being mindful to limit the impact on economic activity and cross-country spillovers, the statement said. Now, there are two very important issues here that it's worth reflecting on. First, this idea of central banks rewarding banks for parking money with them. It's happening in Australia, it's happening under the Federal Reserve, and it's happening in the Eurozone. And in each case, what's happening is that reserves are being paid away by the central bank back to the commercial banks. In other words, the commercial banks' profits are being extended. And this, of course, was never the intent of those facilities when they were set up. Bad planning in the first place. It needs to be fixed, and quickly. Remember that the RBA has negative equity, as now does the Federal Reserve. And ultimately, it could well mean that governments will have to recapitalise the central bank. which is not good. The second point is this exchange rate problem, which is getting very, very significant. Of course, the Aussie dollar has dropped dramatically down towards 62 and will continue to fall. And Japan is struggling, as is the pound and the Eurozone as well. This is because, of course, the US dollar is supremely strong at the moment. That's by design. And it is also, of course, directly connected to the higher interest rates charged in the US at the moment. But the point here is that the high interest rates and those exchange rates are putting huge pressure on many other countries, including developing countries. And unfortunately, it seems to me that the Federal Reserve and the US is really, despite their lip service to these G7 agreements, only interested in fixing up what's going on in the US, which means that the pressure on exchange rates and therefore currencies around the world is likely to continue. And it's worth reflecting that whilst that might make some of our exports cheaper, our imports get more expensive. And here in Australia, of course, we import oil and many other things too. That feeds into higher inflation, and those higher inflationary forces then require central banks to put interest rates higher. So there are some arguing that the RBA is different, our inflation rate's lower, and our wages growth is lower. But the impact of the exchange rate and the potential for inflation to be imported means the RBA is also going to have to keep dancing the higher rate cycle. And that's one reason why I think that the bond markets in Australia are now predicting a rate closer to 4% by the end of next year and into 2024, whereas a few days ago it was much lower. So you can see here that the stresses and strains in the financial system are getting more extreme. Expect to see more of this ahead. Markets will fall further, more volatility on exchange rates and bond markets, and more pressure on central banks also to deal with some of the anomalies that they created in the first place. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.